Hi, welcome back. In this session, I'd like to talk about something we take for granted in finance, in markets, and investing. And that is that there is something out there that is truly risk-free, and that we know what rate of return we'd earn on that investment. I remember in my first finance class, we were introduced to the notion of a risk-free investment. The discussion might have been perfunctory, but my reaction was, why are we talking about something so incredibly boring when we should be talking about stocks and default-ridden bonds and risky things, because that's where the excitement lies. And then I noticed that the risk-free investment kept coming back over and over again in the class. It came back when we talked about how to get expected returns on risky investments. It came back when we talked about how differences in risk aversion play out in portfolios. And it came back again when we talked about how to price options and forward contracts. The risk-free rate is central to investing, and most of us have been brought up on the idea that to get a risk-free rate, all you have to do is look up a government bond rate. More on that later. But that presumption was a presumption I took as well until 2008. For me, 2008 was a wake-up call. Wake-up call to the fact that many of the things we take for granted in finance might not be true. In fact, in the aftermath of the 2008 crisis, I wrote a series of papers. I call these my nightmare papers. One of those, of course, was, what if nothing is risk-free? What if nothing is liquid? The reason that came to mind a few weeks ago was Fitch, one of the three big ratings agencies that rates governments, lowered the rating for the US from AAA to AA+. Not a huge downgrade, but a psychological blow nevertheless. In the weeks since, I've been receiving emails and questions about how does this change how we think about investments and investing and expected returns and valuation. And as a lazy person, I thought I'd take everything I thought about risk-free rates and how things will change if in fact the US is no longer a AAA rated country, and put it into this session. So let's go back. Let's think about what it is that makes for a risk-free investment. I told you my first introduction to risk-free investment was in my introductory finance class. But that discussion lasted about 45 seconds. During those 45 seconds, I was told to use the US Treasury as my risk-free rate and moved on. Shows you how dollar-centric finance education was and how the presumption was if it's a US Treasury, it will never default. Of course, that assumption is being challenged, but let's step back and think about what it is that makes for a risk-free investment. On a risk-free investment, you know exactly what you're going to make with certainty. So if you tell me you're going to make 3%, at the end of the period, you look at what you made, you're always going to make 3%. So already you can see that if you're going to talk about risk-free rates, you've got to specify over what duration. Why? Let's say your time horizon is 10 years. You want something risk-free for 10 years. A 6-month security, even if you believe the US Treasury is default-free, a 6-month T-bill is not risk-free if you have a 10-year time horizon. Why? Because at the end of 6 months, you've got to reinvest again, and you don't know at what rate. There's uncertainty about the rate at which you can reinvest or reinvestment risk. So 6-month time horizon is not risk-free if you have a 10-year time horizon. And similarly, if you have a 6-month time horizon, you buy a 10-year bond, you're asking for trouble because at the end of the 6 months, you might collect the coupon that was guaranteed, but the price could change. Why? Because interest rates change. Remember, in 2022, the 10-year T-bond dropped by 20% during the course of the year. That's not risk-free if you have a shorter time horizon. So once you've specified the duration, there are two conditions for an investment to be risk-free. The first is there can be no default risk in the entity issuing the security, not even an iota. Because if there is default risk, you don't know your returns with certainty. The second is there can be no reinvestment risk. A true risk-free investment should be matched up to your duration. What does that mean? If you have a 5-year time horizon, if you want something truly risk-free, you need to find a 5-year, zero coupon, default-free bond. Notice the qualifiers. You need default-free, but you also need zero coupons because if there are coupons, those coupons have to get reinvested at rates you don't know. If you're a purist, getting risk-free rates is already a mess because each period will have its own risk-free rate. but they're all built on the presumption you can find something default-free. You may say, why do I care? Why does a risk-free rate matter? It shows up in multiple places in investing. First, let's face it, we as investors have different degrees of risk aversion. Some of us are more risk averse than others because of our age, our standing in life, our responsibilities. And the primary mechanism for showing differences in risk aversion in investing is not in what you buy, what kinds of stocks you buy, but how much money you hold in something risk-free and how much you put into risky assets. If you're truly averse to taking risk, most of your money should be in something risk-free or close to risk-free and very little in risky assets. If you truly want to take a lot of risk, you're going to have much less in the risk-free investment and a lot more in risky asset. Your asset allocation decision is driven by risk-free and risky investments. Second, if you're looking at risky investments, you need a hurdle rate, some rate of return you need to make for that investment to be a good investment. The risk-free rate becomes the base from which you build those expected returns. You start with the risk-free rate and you add a risk premium. And that risk premium we've talked about can vary depending on whether you're in the equity market or the corporate bond market. By the same token, because expected returns on risky investments build off the risky rate, if you're a company or a business making investments, your hurdle rates are going to be driven by what happens to the risk-free rate. A rise in risk-free rates, as we saw last year, will push up the hurdle rates for companies, which means investments have to make higher returns to justify being taken, and existing investments, which started off as good investments, could very quickly turn on you. And there's a final place you're going to see risk-free investments play a role. Arbitrage, the essence of arbitrage, though it's a much misused word, is you create a position that's essentially risk-free. And it's actually an opening we use to price options and derivatives. Why? Because you have a call option or a put option on a stock, or a forward or a futures contract on a commodity. There is a way in which you can create a riskless position, an arbitrage position, so to speak. You're saying, so what? Well, if an arbitrage position is truly riskless, it should earn the risk-free rate. In fact, that's the opening that we use that allows us to come up with option pricing models and forward pricing models. The risk-free rate plays a key role. So the truth is, we need to know what the risk-free rate to do much of what we do in finance. So what is it that truly drives the risk-free rate? If your answer is central banks, you've already lost the script. Ultimately, there are two fundamentals that drive the risk-free rate. The first is expected inflation. And here's why. If you expect inflation to be 5%, why in God's name would you buy a bond which offers you a 2% return? You're settling for less than inflation. Sensible human beings, and I know that's often a quality and that's scarce, sensible human beings should start with the expected inflation and build up. So if expected inflation is 2%, you should demand 2% plus on a bond. And if inflation goes up, you should expect the risk-free rate to go up. The second is when you lend money, buy a bond, you're setting aside current consumption for future consumption. You're sacrificing. And to get you to sacrifice, I need to offer you a real rate of return. Now we can debate what drives that real rate of return. But in the aggregate, that real rate of return is going to be determined by the supply of savings in an economy and the demand for those savings from projects and investments. Put simply, high growth economies should have much higher real interest rates. Already you can see the makings for why interest rates can vary across time, and as we'll see soon against currencies. Differences in expected inflation and difference in real interest rates. I know you're saying, where is the Fed or central banks in it? Only at the margin. I know that cuts against conventional wisdom, but let me back it up. What you see in this graph are essentially two lines. The black line that you see through the chart is the 10-year T-bond rate. And as you can see, it goes up and down. You had the peak in the 1980s, the bottom in the last decade. You're saying, what are the columns that make up the other line? The red part of the column is the inflation rate in a year, and the green is the real GDP growth. I'm adding the inflation to real GDP growth to get a rough proxy for what I call my intrinsic risk-free rate. Now, I won't belabor the point, but you can make your own judgment as to whether the two move together. Why were rates so high in the 70s? Not because the Fed willed it to be so, but because inflation was high. Why were rates low in the last decade? It wasn't because of QE1 or QE2 or whatever other Fed move there was, though that could have had an effect at the margin. It was because inflation was low and real growth was anemic. Low plus low is low. Why have interest rates gone up in the last 2 years? Again, you're going to jump to the conclusion the Fed raised rates. No, not really. It was because inflation went up. This forces us to think about what it is that truly drives risk-free rates over time. Now, of course, if you've come up with that decision that risk-free rates are driven by expected inflation and real interest rates, the next question becomes, how do we measure a risk-free rate? Now, I'll give you the backing for the conventional wisdom that government bonds are risk-free. It's built on two presumptions. The first is that governments control the printing press. What does that mean? If a government borrows money in the local currency, and that's where the argument for the government bond rate is, and it needs to pay off those loans, those contractual obligations, even if it doesn't have the money, it can print the money. It controls the printing presses. Already you can see the exceptions, right? There are governments that don't control the printing presses of their own currency. Take the EU. All those countries that share the euro. The Greek government cannot pay off its euro bonds by just printing euros. But most governments do control the printing press. So that's a plus in favor of using the government bond rate. The second is trust. Trust in what? Trust in the belief that governments, if they have a choice, will not default. The shame, the consequences are supposedly so great, but the governments can be trusted not to default. We're going to talk about the trust deficit that's opened up in the last 15 years, but the history of trusting the government bond rate as risk-free is built on those two presumptions. You're saying, what's wrong with those assumptions? They sound pretty reasonable. The first is they're at war with the facts. Governments do default, not just in foreign currency bonds, which you can understand, but in local currency bonds. They choose not to print money, even though they have that option. This table, I've looked at the percentage of bonds in different ratings classes that default. Of course, foreign currency bonds. First, notice the pattern. As your rating drops, the default rate goes up. And a backhanded compliment to the ratings agencies, at least broadly. But notice that if you look at the local currency defaults, they're not zero across the board. They're pretty substantial. They're lower than foreign currency defaults, but they are still substantial. Governments do default. And if you think about the trust issue, since 2008, I don't think there is any argument against the reality that we've lost trust. We've lost trust in governments, we've lost trust in institutions. Prior to 2008, if you told people the US government could default, you'd probably have been laughed at, or the UK government. But the 2008 crisis has opened up that possibility. I think, we'll come back and talk about how this trust issue has played out in the crypto and the NFT boom. But I think it'd be hard-pressed to find somebody who completely trusts their government anywhere in the world, even the German government, the Swiss government. Once you've sown those embers of distrust, it's very difficult to shut the door. So governments do default and trust has eroded. But why would governments default? The pain should be so consequential. Why would they not print more money? Well, governments do default for two reasons. One is economic. They just don't have the money. They run out of revenues. And that's going to be a function. That risk is going to be a function of how concentrated the economy is. The reality is, over much of the world, countries have economies that are heavily concentrated, especially on commodities. And if the commodity price drops, they're in trouble. It depends on how much debt the country has. The more debt it takes on, the more it's exposed to default risk. Though it's kind of a qualified statement, because if you look at the countries with the most debt, Japan is way up at the top of the list. And I don't think too many people are worried about Japan defaulting. And finally, it depends on the efficiency of the tax system. Countries ultimately need to collect tax revenues to make their debt obligations. If your tax system is inefficient or doesn't do its job, you're in trouble. There are also political reasons. Default is as much a political action as it's an economic action. Now, if you have a functional political system, neither side of the partisan divide wants default because they all think about the pain it inflicts. But if you have a dysfunctional political system where each side thinks that default is the other side's fault, that they can blame it for it, then default can happen for political reasons. But ultimately, governments choose to default because the alternative of printing money creates debasement. Currencies have more inflation, and that creates a different kind of distrust. So for better or worse, governments can and do default, either for economic reasons or political reasons. We'll talk about why it matters, what the reason is. I think economic reasons are more intractable. It's more difficult to fix an economic problem. Political reasons are fixable. You can inflict your pain on the other side. Eventually you agree, you come back to the table. We'll use the US to talk about which reason has caused the downgrading and talk about the consequences. But assuming governments can default, the question is, how do you measure that default risk? I've talked about this before, but the simplest, most widely used measure of default risk are what sovereign ratings agencies attach to countries. Fitch, Moody's, and S&P are the big three. They all provide sovereign ratings for countries, and they provide both a foreign currency and local currency rating. With sovereign ratings, the presumption, at least on the part of investors, even though ratings agencies actually don't explicitly say that, is if you're a AAA rated country, you have negligible or no default risk. Though the ratings agencies themselves have walked back from this concept. And of course, the statistic you can use to back it up is no AAA rated country in the last 50, 60, 70 years has ever defaulted in the 15 years after getting a AAA rating. So even if you slide, you don't slide enough to default within 15 years. All that said, though, the number of AAA rated countries has decreased over time. In fact, if you look at the countries that have AAA ratings from all three rating agencies, there are only 9 left. There's the Scandinavian countries, you got Luxembourg, Singapore, and Australia, and you got Switzerland and Germany. Canada is rated AAA by 2 of the ratings agencies, and before the Fitch downgrade, so was the US, but now the US is rated AAA only by Moody's. To kind of give you a sense of how the world has changed on this front, and this is again, I think, a reflection of the erosion of trust, I look at the number of countries with AAA ratings on Moody's, on one ratings agency through time. And essentially you can see each year one or another country drops off the list, leaving fewer and fewer countries on the list. Now Moody's, as I said, still rates the US as AAA. And that might be only a matter of time before it too comes to the same conclusion as Fitch and S&P. The problem with ratings agencies, of course, is they put countries into discrete buckets. In other words, a AAA rated country is a AAA rated country. We assume that all AAA rated countries are equivalent, and that's not necessarily true. Even within each ratings class, there are variations. Default risk is a continuum. It's not discrete. One market where you can see this play out is the sovereign CDS market, the market where you can buy insurance against default risk. And here you can actually see US default risk as seen through those market lens over time. This is the US sovereign CDS, the 10-year CDS, going back to 2008. And you can see on a weekly basis what that sovereign CDS spread has done. There's a 2008 banking crisis. You see the spike in the sovereign CDS spread. The world was coming apart. And then you notice that there are periods where you have what is essentially political disagreement and dysfunction driving default. The US has this mechanism where you need congressional approval to raise the debt limit, which means each time you approach the debt limit, there is an incentive for people to play partisan games. And you've seen that happen over the last 15 years. July of 2011, there was a debt cliff stalemate which pushed up the sovereign CDS spread. A couple of months later, notice later, not before, S&P downgraded the US, the first ratings agency to downgrade in August of 2011. Then in 2012, again, another budget stalemate, again, another cliff approaching. It's got solved in the last 2 days as the previous cliff was. The presidential elections have created little spikes in the sovereign CDS spread. Earlier this year, there was another debt ceiling standoff. In May of 2023, you see the spike again. And Fitch downgraded the US, partly in reaction to that debt ceiling standoff, and dropped its rating from AAA down to AA+. That was in August of 2023. And you can see in the 2 weeks since, not much has happened to the sovereign CDS spread. What's the bottom line? The US has had default risk vary across time. Even if its rating had remained AAA, you'd have noticed spikes and drops in the spread. The ratings agencies themselves have not caused the spreads to widen. They just reflect as and often late to the party. But overall, this is a much more continuous measure of what's happening to default risk. So you can use ratings and default spreads, or you can use the sovereign CDS market as a measure of default risk. You're saying, what now? Once you accept the proposition that governments can default, there's cleaning up to do. Let's start with the risk-free rate. If you ask me for a risk-free rate in a currency where the government has default risk, I can no longer use the government bond rate as my default free rate. And you can see why, right? On July 1st of 2023, the Turkish government bond rate in lira was 16.35%. The Turkish government has default risk. You can see this both in the sovereign CDS market, and you can see it in the sovereign rating for Turkey, in the local currency rating. In fact, based on its rating, if you look at the default spread you'd have assigned to Turkey on July 1st, it's been 6.95%. You subtract that from the 16.35% government bond rate. You're taking out the default risk. You come up with a risk-free rate in lira of 9.4%. And you can see I've taken about 30 currencies where I was able to find a 10-year government bond rate and netted out the default spread to come up with the risk-free rate. So the blue portion of this graph are my risk-free rates. And even after cleaning up, notice my risk-free rates vary across currencies. Now, before you use these risk-free rates, a note of caution, they're built on the presumption that the government bond rate comes from a market where there's trading set by demand and supply. And that's questionable once you get to markets where the government bond is not widely traded. The government may be able to influence what that rate is. Is it true that the Vietnamese dong risk-free rate is negative? Because if you believe the Vietnamese government bond rate is as low as it is, that's where you'll end up. So in some of these currencies, you might look at the risk-free rate and say, well, I don't think that risk-free rate is right. You're saying, how do I check? Here's a simple check that draws on the notion that inflation is what drives risk-free rates. Ultimately, differences in risk-free rates across currencies are driven by difference in inflation, which means that you can estimate the risk-free rate in any currency by starting with a currency where you think you know the risk-free rate and adjusting for the difference in inflation. Let's take an example. Let's say the euro risk-free rate is 2.4%, and you believe that Turkey has inflation 10% higher than the Eurozone. You add the 10% to the 2.4%, you come up with 12.4%. That's the approximation. There's a fuller adjustment that will give you a slightly higher answer. But essentially the differential inflation added on to a risk-free rate in a different currency. So taking the Vietnamese dong, here's an alternative calculation of the risk-free rate. On July 1st, I believed that the T-bond rate was the risk-free rate in US dollars, 3.77%. According to the IMF, the expected inflation in Vietnam is 5.08%, 2.08% higher than the US expected inflation of 3%. You add that 2.08% to 3.77%, you come up with 5.85% as your risk-free rate, using the approximation. With the full adjustment, it's 5.87%. But basically, you can see that you come up with a much higher risk-free rate. So what if with US Treasuries? I mean, right now, I'm still using the US Treasury bond rate as my risk-free rate because I've used Moody's as my ratings agency for the default risk computation for the last 20, 25 years. But let's say S&P and Fitch are right and Moody's is wrong and the US doesn't deserve a AAA rating. Let's say it deserves really a AA+1 rating, which is the next lowest rating below AAA. Well, you say, what do we do? No, you got to do what I did with the Turkish lira. You got to start with the US T-bond rate, but you can't stop there. So if the T-bond rate is 4.1% as it was in August of 2023, and you take the sovereign CDS market estimate of the default spread for the US of 0.3%, you subtract that from the 4.1%, you come up with a risk-free rate of 3.8%. Not rocket science, but you can see it adds a layer of estimation to your risk-free rate. You're saying, what about risk premiums? Again, there's some tweaking that needs to be done. At least the way I compute equity risk premiums is I start with an implied premium for the US, and I then attach a premium to every mature market, and I define mature as being every AAA rated market. So in July of 2023, I estimate an implied equity risk premium in the US of 5%, but then attached to Canada, to Germany, to Singapore, to Norway, to Sweden, all the countries with AAA ratings. You see how things are going to change if Moody's also joins the parade and lowers the rating? I'll have to start with the US implied equity risk premium because I still think the S&P 500 offers you the richest data sources for estimating the premium. But rather than use that as my premium for every mature market, I have a cleaning up to do. So if you take the default spread of 0.3% as the default spread for the US, if you remember, I applied a multiplier 1.42 to that default spread to come up with the risk premium for a country. Subtracting that from my 5% will give me a mature market premium 4.58%. So then Canada, Germany, Australia will get 4.58%. The US will get 5%. And every other country's premium will have to be built off the 4.58%. Do I want to do that? Not necessarily. Not really. But if the US gets downgraded, that's exactly what I plan to do January 1st of 2024. So if Moody's joins the parade, expect that to be my adjustment. Now, what does this all mean for you as investors? As investors, we don't realize how much we value safe havens until we lose them. Investors assume that there is some safe place to put your money. For US investors, that safe place has been US Treasuries. And that assumption, I think, has been undercut over the last 15 years. It's not just the ratings agencies doing their thing, it's also the loss of trust. And when you believe there are no safe havens, investing changes entirely. You're saying one investment going away makes that much of a difference? Yes. Without a safe haven, market corrections will not have predictable patterns. I mean, remember we have that flight to safety during crises. Now, what you flee to might become very different when you don't believe US Treasuries are default free. And I think it also explains, that loss of trust also explains the selling of cryptos and NFT. Because let's face it, one of the big sales pitches is you can't trust governments. You got to put your money in something safe. I would not put my money in Bitcoin as my safe haven, but I can see the appeal to other investors saying, you don't trust governments, where are you going to put your money? So my final points about risk-free rates. Risk-free rates go with currencies, not with countries. There is no Eurozone risk-free rate. There is a risk-free rate in euros. There is no risk-free rate for the United States. There is a risk-free rate in US dollars. If I choose to value a Brazilian company in US dollars, I want a US dollar risk-free rate. So the notion of a global risk-free rate is fantasy. And in fact, using the lowest of all of the government bond rates as your global risk-free rate makes no sense. Second, investment returns, when we talk about them, should always be currency explicit and should relate to the time you make them. So if you tell me that you're going to make a 12% return on a stock and ask me if it's okay, I'm going to ask you a follow-up question. In what currency? If you're making 12% as your return on a stock in Zambia and Kwacha, you might be able to make more on a risk-free investment in Zambia and Kwacha. That's definitely not good. A 12% return in Swiss francs? Well, that's pretty good. Similarly, a 12% return in US dollars in 2022 or 2023, I can live with. It's well above the risk-free rate in US dollars. A 12% return in US dollars in 1980, not so good. Third, currencies can't change the end result of your analyses. They're a measurement device. I mean, I've used this analogy often. Currencies are like, how you measure the weather how hot it is, whether it's in Fahrenheit or Celsius. I cannot make a hot place cooler, but replace a Fahrenheit measure with a Celsius measure. They're calibrators. You essentially should not find a company to be undervalued in one currency. And when you switch currencies, find differently. There are lots of things you need to do correctly for that to happen, but currencies by themselves should not change the direction of your analysis. And finally, I hate to repeat this, but I'm going to do it anyway. No one, no central bank, no government can fight fundamentals. In other words, if you have high inflation, I don't care how much central banks try and governments try, your interest rates are going to be high because of the high inflation. We've got to stop acting as if central banks set rates and recognize that the fundamentals are what drive rates. It'll make this entire discussion healthier. I hope you found this session useful, and I thank you very much for listening.